Hey everyone, and welcome back to the channel. Today, we're re-diving into a Nobel Prize-winning idea that completely changed how we think about investing. Modern portfolio theory, or MPT. I know it sounds super academic, but I promise to break it down in a way that's simple, practical, and can genuinely help you become a smarter investor. So, what is MPT all about? At its core, it's a framework for building an investment portfolio. Its main goal isn't just to pick winning stocks, but to maximize your portfolio's expected return for a given level of risk. Or, to put it another way, it aims to minimize your risk for a given level of expected return. It's all about finding that sweet spot, that perfect balance. The genius behind MPT, Harry Markowitz, basically said that we shouldn't judge an investment solely on its own merits. Instead, we need to look at how it behaves in relation to everything else in our portfolio. This is where the magic word comes in: diversification. Now, I know what you're thinking. Diversification, just don't put all your eggs in one basket. I get it. But MPT takes this idea a massive step further. It's not just about owning lots of different things. It's about owning different things that don't all move in the same direction at the same time. This concept is called correlation. Imagine you own 2 ice cream stands, one in Miami and one in Alaska. That's diversification, right? 2 different locations. But what if a global sugar shortage hits? Both of your businesses will suffer. They are highly correlated. Now, imagine you own 1 ice cream stand in Miami and a company that sells winter coats in Alaska. When it's sunny and hot in Miami, your ice cream sales are booming. At the same time, no one's buying winter coats in Alaska. But when winter hits Alaska, coat sales go through the roof, while your Miami ice cream stand might see a little slowdown. See how that works? One business zigs while the other zags. By combining these two, the overall ups and downs of your total investment become much smoother. You've reduced your overall risk without necessarily sacrificing your potential for profit. That's the power of low or negative correlation, and it's the heart of modern portfolio theory. MPT uses math to find the optimal mix of assets that are not perfectly correlated. So how do we apply this in the real world? Let's talk about asset classes. Think of things like stocks, bonds, real estate, and maybe even commodities like gold. Historically, these different asset classes don't move in perfect sync. When the stock market is soaring, the bond market might be moving more slowly. When stocks take a dive, sometimes investors rush to the perceived safety of bonds or gold, pushing their prices up. MPT suggests that by combining these different asset classes in the right proportions, you can build what's called an efficient frontier. Fancy term, simple idea. Imagine a graph. On one axis you have risk, and on the other you have return. The efficient frontier is a curve that represents all the best possible portfolios you can build. Any portfolio on that curve gives you the absolute highest return possible for its level of risk. Your job as an investor is to find the point on that curve that best matches your personal risk tolerance. Are you a young investor with decades ahead of you? You might choose a portfolio on the efficient frontier that has higher risk, but also a higher potential return, maybe with a larger allocation to stocks. Are you nearing retirement and need to preserve your capital? You'd pick a spot on the curve with lower risk and lower expected returns, likely with more bonds. The key is that MPT ensures you're not taking on any uncompensated risk. Every bit of risk you take should come with a corresponding potential for reward. Now, MPT isn't perfect. It relies on historical data to predict future returns, volatility, and correlations. And as we all know, the past doesn't always predict the future. Events like the 2008 financial crisis showed that in extreme panic, all asset classes can go down together. But despite its limitations, the core principles of MPT remain incredibly valuable. It forces us to think of our investments as a whole, a single team working together, rather than a collection of individual star players. It emphasizes disciplined, long-term strategy over chasing hot stocks. And most importantly, it gives us a logical framework for managing the one thing we can't avoid in investing: risk. So next time you look at your portfolio, don't just ask, is this stock a winner? Ask, how does this investment fit with everything else I own? Is it helping me build a more robust, efficient portfolio? That's the MPT way of thinking. I hope this helped demystify modern portfolio theory for you. It's a powerful tool, and understanding its basic concepts can make a huge difference in your investment journey. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe for more content to help you invest smarter. Thanks for watching, and I'll see you in the next one.